Get ready for the biggest stories hitting your feed right now. A Chattanooga company is teaming up with a publicly traded national venue developer to bring a massive $300 million, $12,500 seat amphitheater to the Tennessee River off Riverfront Parkway. This is set to be one of the city's largest entertainment venues ever built. We dive into the details of this huge project next. And staking revenue are balancing out a substantial unrealized loss on crypto assets. And who is leading the charge with the new CEO? Find out the full picture of this volatile market move. And finally, we look at the enterprise AI space with C3 AI. Tom Siebel has returned to the CEO role, and the company is reporting preliminary financial results showing a non-GAAP operating loss better than guidance, signaling a major pivot. Don't miss the full breakdown of C3 AI's performance and what this leadership change means for the future. Stay with us for the rest of the news. Chattanooga is set to host one of its largest entertainment venues with the planned development of a $300 million amphitheater on the Tennessee River. A local Chattanooga company has entered into a partnership with a publicly traded national venue developer to bring this major project to fruition. The amphitheater, which is slated to have a capacity of 12,500 seats, will be situated on the riverfront, specifically off Riverfront Parkway. This ambitious project is poised to significantly enhance the city's entertainment landscape and draw major regional and national events. MacroGenics, Inc. is restructuring its operations by selling its Good Manufacturing Practice, GMP, Drug Substance Manufacturing and Contract Development and Manufacturing Organization, CDMO operations in Maryland to Bora Pharmaceuticals. The agreement involves an upfront cash payment of $122.5 million, with the deal structure also including potential post-closing payments of up to $5 million, contingent upon achieving specific manufacturing milestones, and providing professional development services in 2027 and 2028. The transaction signifies a strategic shift for MacroGenics, moving it toward a more asset-light, research and development-focused model by monetizing its manufacturing infrastructure while retaining supply access. Bora Pharmaceuticals will assume control of the Rockville manufacturing site, which boasts a total capacity of 11,000 liters, along with the Frederick warehouse. Furthermore, Bora is expected to onboard approximately 140 MacroGenics employees. Following the closing, MacroGenics and Bora plan to establish key agreements, including a manufacturing and supply agreement, a transition services agreement, and a sublease. The transaction is anticipated to close in the third quarter of 2026. Key factors for successful completion include the smooth transition of CDMO operations, the execution of the new supply and transition services contracts, and the realization of the milestone-linked earnout payments. This move aims to secure production support for MacroGenics pipeline under defined contractual arrangements. Ton Strategy reported mixed financial results for the first quarter of 2026, highlighting the significant impact of its Tonkin treasury operations and unrealized crypto asset volatility. The company reported total revenue of $5.3 million, which included $3 million derived from staking activities. Despite this, the company posted a net loss before taxes of $91 million, which was heavily influenced by an $87.9 million unrealized net loss on crypto assets. As of March 31, 2026, Ton strategy held approximately 221.9 million ton, valued at $272 million. Based on May 6 prices, this holding was estimated to be worth $433.3 million. The company maintained a strong balance sheet, holding $35 million in cash and no debt. Recent operational highlights show positive movement in staking productivity. Following major network upgrades implemented by the Open Network in April 2026, the gross staking yield increased significantly to 1.39% from 0.34% in March 2026, marking a fourfold month-over-month rise and a 16.7% annualized increase. This network improvement, coupled with broader market strength and Telegram's strategic announcements, contributed to a significant appreciation in Tonkin value, pushing the estimated treasury value to $433.3 million. CEO Kevin Wilson emphasized the company's foundation, including its position as the largest public company treasury dedicated to Tonkin, active staking operations, and strong infrastructure. Wilson stated the focus will be on translating this foundation into a clearer public company platform for Tonkin exposure, prioritizing long-term per-share value and thoughtful capital allocation. Conversely, the Q1 results underscore the sensitivity of the business to Tonkin price movements, contrasting with previous periods where ton-related gains provided positive reactions. Management noted that future performance will be tracked by staking productivity, expense levels, and the sensitivity of results to Tonkin price fluctuations. The company is scheduled to hold a conference call on May 12, 2026, to discuss these results. The report signals a strategic pivot where staking revenue and the volatility of Tonkin holdings are now the primary drivers influencing the bottom line. C3 AI, the enterprise AI application software company, has released preliminary financial results for its fourth quarter and full fiscal year ended April 30, 2026, alongside significant executive leadership changes. The company reported a non-GAAP loss from operations, excluding approximately $10.8 million in pre-tax restructuring expenses, resulting in a non-GAAP loss of $498.5 million for the full fiscal year 2026. Fourth quarter revenue reached $51.6 million, which remained within guidance, while the non-GAAP operating loss was better than expected. In a major leadership update, Tom Siebel has returned to the role of Chief Executive Officer, effective May 8, 2026, while continuing as Chairman of the Board of Directors. Stephen Ehikian remains in his role as President, reporting to Mr. Siebel. Siebel expressed enthusiasm about leading the company into its next phase, emphasizing the partnership with Ehikian to achieve consistent free cash flow generation, non-GAAP profitability, and a return to significant top-line growth. Financial commentary highlighted the positive impact of the company's restructuring plan implemented in the fourth quarter, which was designed to deliver approximately $135 million in annualized non-GAAP cost savings and reduce cash burn by a similar amount. Chief Financial Officer Hitesh Lath noted that the results reflected the early benefits of these cost actions. The company ended the year with $575.4 million in cash equivalents, and investments, positioning the firm to drive operating leverage as savings fully materialize in the second half of fiscal year 2027. From a business perspective, C3 AI secured 28 agreements during the quarter, including 9 new initial production deployments, IPDs, and 7 IPD conversions, signaling strong customer validation and an accelerating opportunity within the enterprise AI market despite lower-than-expected bookings. The company continues to focus on its integrated product family, which includes the C3 Agentic AI platform, industry-specific SaaS applications, and C3 generative AI offerings.